For the stock market crash, so I can break down Black Tuesday. Compare and contrast Hoover and FDR. Notice the asterisks. We'll get to that at the end of the video. And then infer how fear affects an economy. Here is the Great Depression. This is the Dow Jones, the stock market. What I just want you to notice is just the giant plunge here will let you know the giant drop in the economy. We talked about in the last video the four causes of the Great Depression. These are not really the causes of the Great Depression, but if you want to pass your AP test, you give them economic income disparity, over speculation, overproduction, too many loans. Sure, they had a little bit to do with the Great Depression, and they definitely were contributing factors, but to say that these four things were the big cause, it's just not true. But you need to put that if you want to get a 5 on your AP test. Let's look at this chart. What we're really concerned about is this giant drop here. And the Great Depression, this giant evaporation of wealth. Now, again, the AP is going to tell you, well, this is what caused all that money to disappear. Well, if we just read any legitimate economist, we will understand. We'll look at basic economics from Thomas Sowell and have a pretty good explanation of what really happened. And the real reason for this giant drop, it's not so much the giant drop, it's the giant increase. We're all focused on why did it go down? Well, also, why did it go up? And the reason why it went up was inflation. Inflation is the general rise in prices. So look, hey, the price of goods went up. Imagine cars, imagine gallons of milk. The prices are going up. Also, that means that the value of the dollar goes down or it buys less. We'll just look at it as the price goes up. So we're really focused right here because this increase is going to lead to this decrease. Inflation is the general rise in prices. There's your general rise in prices right there. When people have more money, they tend to spend more. If you have more money, guess what you're going to do with that money? You're going to spend that money. You're going to buy more goods. So demand is going up. And as we know, when demand goes up, prices go up. But also, when quantity demanded exceeds the quantity supplied at current prices, either people bid against each other during the shortage or sellers realize the increased demand for their products at existing prices and raise their prices accordingly. All right, so I'm going to break this down for you. So we know that people are buying more and they are demanding more, but we have not changed the supply of goods. People have more money to spend, so they're demanding goods more. Demand increase causes a price increase, but we have not increased supply. So imagine a world where we've just given everybody a bunch of paychecks. I don't know, imagine giving everybody a $1,200 check, but we have not increased the supply of goods. They're still just in this universe that we're thinking of just 1 gallon of milk. Everyone's got money, but there's only 1 gallon of milk. Guess what? We're going to bid against each other like it's an auction. I'll give you $5. I'll give you $10. I'll give you $20. I'll give you $300 for that one last gallon of milk. See what's happened here? The price has increased because we have increased demand without increasing supply. So the price of goods has increased, just like on that chart I showed you, the price going up. That's because we've increased demand by increasing the money supply. Or a seller realizes that the increased demand for their products at the existing price, and they raise them accordingly. Imagine on Monday, 20 people walk into your shop, and then on Tuesday, 40 people walk into your shop, and then on Thursday or Wednesday, 100 people walk into your shop, and you have not changed the prices. If you are a smart business person, you realize, whoa, people really like my stuff. I could probably get away with selling it for a higher price. There isn't some secret conspiracy where business owners understand inflation and they raise their prices. They just watch and they pay attention to demand and they realize, boy, we are selling a lot of Takis this week. I bet we could charge more for Takis and people would still pay. That's how it works. Either people bid the prices up in an auction or the sellers realize the increase in demand and that we have not increased the supply. That's what inflation is. That's right here. That's all this was. The Great Depression was just an increase in price because of an inflated currency, not because of overproduction, not because of income disparity or over speculation and buying on the margins or too many loans. Sure, those definitely were contributing to the rise here in the economy during the 1920s, but overall, the real reason is the Federal Reserve and the U.S. government was pumping too much money into the economy. The increase in money, when people have more money, they spend more money, that increases demand. As demand goes up, we know price increases, but also we know that inflation happens when you don't increase the supply of goods. We're not producing anything more. Now, The prices are inflated. A correction is needed. Eventually, it's going to come down. So imagine on Tuesday, a gallon of milk was $2. Now all of a sudden, you're spending $4 for the same exact gallon of milk. Nothing has changed. You're like, why is this more? It's because there's too much money in the economy and the demand has increased. Eventually, that gallon of milk will go back to $2 and everything will be fine as long as the government doesn't meddle in the economy. And you don't have to worry. Yes, there's going to be a drop, but if wages drop, so do the prices of goods. So, oh no, I'm getting paid less. Yeah, but also the price of all the goods have dropped as well. These are natural cycles. At least they should be natural cycles as long as the Federal Reserve doesn't mess with the economy too much. But guess what? They mess with the economy too much. There should have been a natural up, a natural down, and then we even out. But government intervention during the Great Depression and probably during the time period that you are watching this video right now with our current economic crisis, government intervention prevents these sudden pains. Obviously, the drop is going to hurt. It's going to be significant. There's going to be a recalibration of the economy, and it's not going to be good for about 6 months to a year, but then you're fine. But if you meddle in the economy with super government, you turn a 1-year crisis into a 10-year problem. That's what happens in the Great Depression. So we have the big drop. Now, the big drop is not necessarily caused by over speculation or income disparity, but you need to put that if you want to pass the AP test. The real reason is as we went up, of course there was going to be a drop, but it did not need to be this significant. The giant drop, according to the Chicago economists and kind of towards the Austrian economists, not necessarily, but deflation during this time period by the Federal Reserve is going to cause an alarming and a disturbing drop. And what is deflation? It's the opposite of inflation. It's when you take the money out of the economy, people spend less, and you obviously can figure out what happens there. There should have just been a natural up and down, but this giant drop, this crater, was caused by deflation. Now, it would have went back to normal, and you'll say, hey, this doesn't look so bad. It's back up to here. Yeah, that's half of the economy. It's only at half of what it was before, so that is kind of bad. But it would have leveled out and returned to a decent economy had the government not intervened. All right, so let's talk a little bit more. So we explained inflation really caused a giant increase, and then there was a deflationary moment, which caused a giant bottoming out. So too much money in the economy, then not enough money in the economy. Those definitely disrupted it. But let's go back and talk about the AP causes and the inflation and kind of tie it together so that you can do well in the AP test and you can know the truth and some of the lies. So again, when the economy was doing well, some wise investors realized, hey, we think inflation is going on. And they also looked at some of the other AP causes like possibly overproduction and buying on the margins. They were thinking about that as well. So let's look at it. So as the economy is going up, we'll imagine you want to buy stock in a car company. Well, you're noticing that the supply is increasing according to AP. This is one of the big causes. I don't believe it's one of the big causes, but let's just go with it. If you know that there is an increase in the supply of goods, you know then that the price is going to drop. As supply goes up, price is going down. So you're thinking to yourself, I think the stock market or the value of this company is going to fall. Remember, we've looked at this chart. It's going up and up and up. Smart investors, wise people are studying the information, studying the government records, studying the businesses, realizing that, and this is today, and this is almost any time during your lifetime, you're going to see the stock market going up, and you're going to have to say to yourself, this cannot go on forever. I need to find out when it's going to drop. So I need to know when to sell or get rid of certain goods. This wise investor says, hey, I think supplies are going up. More importantly, this wise investor knows that the government is pumping too much money into the economy. Maybe he's looking at the records. Maybe he's looking at the interest rates. Maybe he's just noticing the increase in demand. There's a lot of different ways that he could analyze why or how the government is increasing the supply of money, which is increasing demand, without increasing the supplies, which is going to cause inflation. So he knows that the price is going to drop based on that. Also, he knows if there is overproduction and then there is inflation, eventually these factories are going to have to start cutting back. This can't go up forever. And when they start cutting back, they're going to fire workers. People are going to buy less, and it's going to drop significantly. Also, he notices that the Hawley-Smoot or the Smoot-Hawley tariff has reduced sales to Europe because of the trade wars. Kind of similar again to today. And with this happening, the possibility of sales to Europe are non-existent. That's going to cut into your sales, so it's going to drop even further. And so he says to himself, that's overpriced. This is not the true real price of this stock. It's inflated. It's going to have to recalculate or recalibrate. And so he starts selling his stock now before it drops. Now, once he starts selling, other people start seeing other people selling, and this begins the tidal wave, which will lead to Black Tuesday. Why is he selling? I better sell too, he says. Oh, yeah, sell. Everybody starts selling. Here's the problem. He's trying to sell. And people realize It's very quickly that people realize, whoa, why are all they selling? If they're selling, then guess what? I'm not going to buy that. And he says, oh, no, well, I'll sell 2,000. So look, we've already decreased the price of this car company from $1,000. It's already been devalued just like that, magically. And you say, how can that happen? It was worth $3,000. It was worth $3,000 because people were willing to pay $3,000. It wasn't necessarily worth $3,000 because he had $3,000 worth of parts and machines and equipment and capital. It was worth that because that's what people were willing to pay. If people were willing to pay $2,000, and that's what it's worth. And if people will only pay $1,000, and that's what it's worth, because supply and demand determine the price. And the demand is low. Everyone's saying, no, I don't want to buy it. No, I don't want to buy it. So as demand increases, so does the price, and it drops. And you'll hear this on CNBC or Fox Business. What's the best way to catch a falling knife? The answer is you don't. You let it hit the ground and you pick it up. Same thing with the stock as it's dropping. You don't try to buy at 3,000. You don't try to buy at 2,000. You don't try to buy at 1,000. You let it hit the bottom before you start to buy. How do you know when it hits the bottom? That's a great question. You don't really know. But that's the point of the one thing you do is you don't want to buy it before it drops, because if you buy at 2,000, guess what? It kept falling and then you lost 1,000. You thought you were getting a deal here, but you didn't because it continued to drop. So best way to catch a falling knife is to let it hit the floor first. So we know that according to the AP, supply was increasing, and there is some truth to that. That drove price down. We definitely know that supply of money was driving prices down. Or well, not necessarily, it was driving the value of money down. And then we can see here that demand is starting to decrease, and that's going to drop prices. And then what's even worse is, as I mentioned before, we had the inflationary curve where the government was inflating the economy by printing a bunch of money. Right as that was happening, the genius Federal Reserve practiced some deflationary practices, which was they were loaning less money out to banks. So that means banks had less money to loan out. So basically there was less money in the economy. And as we said before, more money in the economy, people tend to spend more. It increases demand, which will increase prices. Well, when you take that money out of the economy, people spend less. And as people spend less, prices drop. And so we had a significant decline, obviously, and then that's how you're going to get Black Tuesday, 1029. So to repeat that, you have inflation, increase the supply. Trade barriers are going to help cause this stock crash, too many loans. But the real reason, this isn't necessarily going to be about AP. These are the things that are going to be in your AP test. There was speculation, too many loans, tariffs, overproduction. But the real reason is the inflationary practice that sent this up. It actually had to go down. It had to go down. Did it need to be this bad? No, the deflationary practices helped make this happen. Like, none of this really has to go all the way up and all the way down. It's the Federal Reserve and the United States government messing around in the economy too much. That's not going to be the answer for the test, though, unfortunately. Here's another way of looking at it. This is inverted. So we see here is the amount of, basically, we'll say the money in the economy, even though it's not necessarily. It's the valuation of certain stocks going high and some of them dropping to almost not worth anything. This is going in a different direction, but because this is measuring unemployment. So here at the crash, you had just under 10% unemployment. In 1933, almost 4 or 5 years after the crash, unemployment reached 25%. And it stayed above 15%, which is unthinkable. I know today we are up there because of the current crisis, but in normal times, to be above 10% is unheard of. And you can see it drops back down here almost 15 years later, which again is unheard of and is a terrible management of the economy because you're managing the economy. The best thing for the government to do is not manage the economy at all, and you would have been like this. And this is not an exaggeration. These cycles, booms and busts, happen throughout America's history, throughout the 18th century, throughout the 19th century, and even the early 20th century. And you would have a crash, but it would last 6 months to a year, and then it would be back to normal because the government did not get involved in the economy. And there wasn't a Federal Reserve manipulating the money supply. But this time you had the Federal Reserve and you had a government that intervened in the economy, and they turned what in the past typically had been a one-year crisis into a 13, 14-year disaster. Black Tuesday, 1029, 1929, half of the money evaporates. So from one perspective, that's terrible. Oh my God, half the money's gone. But also from the other perspective is that this is the true amount of money that probably should have been in the economy. All this money was inflated currency pumped in by the Federal Reserve. This was not a true representation of the value of the companies or of the economy of the United States. This is actually the legitimate number. But the problem is, guys got used to living like it was this. They made investments like it was this. They bought companies like it was this. They were purchasing cars for their wife and their kids like